Seshadri and me, we live in the same building. We've been trying to meet as friends in the building, but I never knew that we would be meeting here first instead of a building and interacting on television. So good to have you on TV. So good to have you as part of
Thanks,
VT now.
Nicholas. Thanks for hosting me. And yes, strange coincidence that we're meeting online rather than in person. Yeah.
With the promise that we should meet soon for an evening walk, let's start our today's interaction. Uh, the governor feels that everybody has the right to win in the banking sector. But if I look at the basic construct, the deposit ratio, the CASA ratio, the market size, all of them is going to an HDFC bank or an ICICI bank, or for that matter, the top 2-3 bank. For next couple of years, who's got the right to win in the banking sector?
You're right. I think the advantage does lie with the bigger banks. They have the liquidity. They have in a rising rate scenario, when liquidity gets tighter, there is an advantage that goes to them. They have distribution and reach. And more importantly, over the last 3-4 years, they have a level of trust with the depositors, with the smaller banks are struggling to achieve. So that's manifest in some of the savings bank rates that the smaller banks have to offer to garner, the most simple and basic of banking products. But that's an advantage. It's not an absolute right to win. It's an advantage that gets them ahead. But thereafter, there is a lot of execution, and especially, I think increasingly, banks will have to deliver on the tech side, the tech experience, the app, online digital experience that the banks have to deliver has to be up there. You may be the biggest bank, you may have the trust of the depositor, but at the margin, if you don't deliver that experience, you're starting to lose customers. There's also a challenge for the banking sector as a whole to convert this deposit into profitable lending. We're seeing over the last 5-6 years that a lot of your high ROA lending portfolios have either disappeared. On the corporate side, there is nothing, everything is pretty low ROA at the moment. Or some of these have become too risky, or banks share of that portfolio is not growing, except from some banks which are coming out of a turnaround kind of situation. So it's complex, but you're right that the bigger banks have an advantage. But there is an opportunity for smaller banks, as you just played in the governor's clip, who are agile, who can deliver a better customer experience to still gain market share and earn higher profitability.
Shadri, for next couple of years is all about betting on the credit cycle. The color of money doesn't matter. It's about a boom in capex and booming working capital. In that specifically, do you think we should not get into this debate of large and small, big and beautiful, technology, non-technology? It is about banks' ability to lend smartly, and that anyone can do when 14-15 credit growth is back.
You're right to a certain extent that this is a rising tide. For the next 2 years, the banking sector will see multiple tailwinds. Credit growth is back, fee growth to some extent, especially on the unsecured, credit cards and those transaction side is back, and credit costs are at a multi-year low. You're going to see very low credit costs at least this year, and probably some of it spilling on into FY24 as well. So financials wise, I think banks are going to have a great time, and we've seen in the past that this rising tide will lift all boats. Investors, however, do need to be careful, because we've seen that weaker banks tend to be more cyclical. Some of them are available at very attractive valuations, but one needs to dig deeper to figure out the sustainability of this growth. And I think those who convince the investors and analysts that their turnaround and the numbers that they are delivering are sustainable, those will be the ultimate winners from a stock price perspective.
At Alchemy, what are you folks doing? Are you betting on big is beautiful or small is also right?
We are playing across the spectrum, Nikunj. I don't think you can be dogmatic and narrow down. It's a huge sector with a huge weightage in all the benchmarks. If you go about it in a straight line method, it's going to be very difficult to manage. So we have positions in some of the larger banks and NBFCs, where we are seeing growth coming back, credit costs falling, ROAs bouncing back to pre-COVID levels. In some cases, ROAs going to lifetime highs. Those are one set of banks that we are investing in. And we are continuing to look for opportunities among the smaller banks. Obviously, when we do that, our due diligence is much greater. We dig much deeper. We take a little more time to get ourselves convinced that this is a lender which can sustain these profitability metrics through cycles. We've seen in the decade of 2010 to 20 that many lenders delivered very high profitability for 2-3 years, and then some of them gave all that back in either credit costs or other ways, mainly credit costs, within a couple of years. So one needs to be careful. So one has to go into the market, figure out what their marketplace practices are. But we are playing across the spectrum. We are not dogmatic in saying we'll only invest in the large banks or only invest in the small banks.
Okay, so you're going to be size agnostic. It's similar to the clip that we had played of the RBI governor before the interview, but something else I want to ask you. You're size agnostic. The markets have historically been very used to a certain kind of a return when it comes to the HDFC twins. That is not the case at the moment. With most of the approvals that are in now for that mega merger, if you look at HDFC Bank year to date, it's still in the red, it's negative returns. What do you think is going to take for the HDFC twins to perform so that retail investors, the markets, once again get the kind of returns they're used to?
Well, one thing that for sure that the HDFC twins have not changed their color in terms of being probably one of the best managed companies, let alone financial services companies in the country. So that has not changed. The opportunity set is very big, and strategically, I think the merger between the bank and the mortgage company is the right thing to do, because together, I think they can deliver much better value both to the customer and over time for the investors. However, from a stock price perspective, happens with any merger, right, where there are certain near-term challenges which the market is nervous about. You're right, Nayantara, that some of these are, they're crossing various hurdles as we go along, right? Now the regulatory hurdles are getting crossed one by one. Next will be the actual merging. They are very well positioned in terms of liquidity. I don't think any other bank would have dared to go in for such a large merger. The HDFC Bank can do this because their deposit franchise is better than everyone else's. But even then, there will be a period of consolidation while they amalgamate this very large HDFC Limited balance sheet into their own. Once that is done and that's sorted out, I have no doubt that from a 3 to 5 year perspective, this bank will be back and deliver, proving to all of us that it is one of the best managed banks in the country. But till that is done, this slightly sluggish stock price behavior could continue. For long-term investors, that's more of an opportunity than a risk, is what I would say.
Right. Seshadri, great to have you on the show today. Thank you so much, as always, for taking the time out and joining in.